Good morning. Today we will discuss regarding depreciation. First of all, what is depreciation? What are the different views or definitions given by different accounting bodies about depreciation, and what characteristics are coming out of those definitions? That should be first of all discussed. This is governed by AS 6, accounting standard 6. As per the requirement of accounting standard 6, what are the requirements of depreciation, why should depreciation be provided, etc. This will be the subject matter of our class. Coming to the concept of depreciation, first of all, the concept of depreciation refers to the process of allocation it refers to the process of allocation of the initial as well as additional costs incurred from time to time on a fixed asset over several periods expected to benefit from their use. I am repeating the concept. It refers to the process of allocation of the initial as well as additional costs incurred from time to time on a fixed asset over several periods expected to benefit from their use. It means if we have purchased a fixed asset, there is some cost, that is the initial cost. Initial cost may be, suppose you are purchasing a machinery for 50,000 rupees, but the installation expenses are 10,000 rupees, incidental expenses in bringing it to our premises is suppose 5,000 rupees, all total it is coming to 65,000, that is the initial cost. Not only that, suppose every year some part will have to be exchanged or you can say added. So, that part is the additional cost from time to time. So, all these expenses, all these costs will be added up and will be divided, incurred from time to time on a fixed asset. It is concerned only about the fixed asset, not current assets, because fixed assets are depreciated, but the current assets are valued. Like take the case of stock in trade. It will be valued. What was the opening stock, what was the closing stock? It will be valued, but it will not be depreciated. So, only fixed assets will be depreciated over several periods. That means that 65,000 rupees or even 75,000 rupees all total expenses throughout the life will have to be divided by the number of expected life. If it is expected to give us a benefit for 15 years, then we can divide that total cost of 75,000 by 15, and each year 5,000 rupees depreciation will be provided, and this depreciation is called the expired cost, which will figure in calculation of our income, or it will be charged to the profit and loss account as one of the expenses. But actually the real depreciation may be more, may be less. Actually depreciation in simple words may be the decrease in the value of a fixed asset over a period of time is called depreciation. That means if the asset value will not decrease, there is no depreciation. Take the case of a land. We have purchased a land and its value is going on increasing, appreciated, not depreciated. So there is no question of depreciation at that time, although it will be fulfilling all the other characteristics of a fixed asset. That means it will give utility for a number of years. Without this we cannot run the business. All these things are there, but because there is no decrease in the value of the asset, we cannot provide any depreciation, rather it is appreciation. But here, going back to our example, that 75,000 rupees which we have spent on installation cost and time to time recurring expenditures also, all total, that is recurring in the sense not revenue in nature but capital in nature. If that will be there, that will be added, and the total expenditure, total cost will have to be divided over the period of expected period of life. It may actually run more or less than the expected period. Suppose the expected period is 15 years. It may go for 20 years also. It may be broken down after 10 years also. But the expected life, we have to expect the future life of this asset, this fixed asset, and divided by this total amount will be divided by the expected life, and that will be the amount of depreciation. It is not an exact calculation, so we call it allocation. We are not providing depreciation, but we are allocating the allocation of an expense. So it is allocated. The depreciation is an allocation of expense. It is not actually a loss or expense, but this is an allocation. In other words, the expected expired cost, as I have told you, expired cost means the benefit which we have already derived, or the depreciation it has already taken place. That is the expired cost of a fixed asset, that is depreciation for each period should be taken into account while computing profit or loss as per the matching concept. Just in the last class we have discussed about the matching concept, and the matching concept tries to compare the revenues and the cost incurred to receive this revenue, and if the revenues are more than the cost, then there is a profit. Now in the costs, within the cost there is an item of depreciation. If depreciation will not be provided, then the profit which you will get, that will be more than the true profit. So the depreciation has got to be provided every year, every period. Then thus depreciation is an attempt to spread the cost of a long lived asset as an expense to the profit and loss account over its useful economic life. This is the definition given by Hanif and Mukherjee. Depreciation is an attempt to spread the cost, the whole cost has been divided, spread the cost of a long lived asset, that means a fixed asset, as an expense to the profit and loss account over the excuse me, over the expected life, because exact life we cannot take into consideration. Exact life nobody knows in future what it will happen, how many years it will run. So, expected future life, all those years it will be distributed over all these years. Depreciation is a permanent continuing and gradual shrinkage in the book value of a fixed asset. Let us discuss about this definition. This is a popular definition. Depreciation is a permanent, continuing and gradual shrinkage. Permanent means every year this depreciation will take place and we have to provide for. Then continuing, not that after 5 years it will be stopped. It will continue till the last year of its life. Then gradual, not that all at a sudden all the cost we have incurred on a fixed asset is coming to 0. So, it is a gradual 5,000, 5,000, 5,000, like for 15 years we are deducting 5,000 from the cost of the asset, so that it is coming to 0. Then shrinkage in the book value. Shrinkage means coming down, shrinkage means coming little bit less and less and less, like this. The quantity is reducing or the amount is reducing in this case. In the book value, what is book value? Cost less depreciation up to date. Technically, cost less depreciation up to date is called book value. So, in the initial year, first year, the book value will be equal to the cost itself. So, depreciation is a permanent, continuing and gradual shrinkage in the book value of a fixed asset. Again the emphasis is on fixed asset, because the current assets do not have any depreciation, only the fixed assets will have depreciation. Now, we will come to one important definition given by ICAI. So, Institute of Chartered Accountants of India has given this definition of depreciation: a measure of the wearing out consumption or other loss of a value of a depreciable asset arising from use affluction of time or obsolescence through technology and market changes. A measure of the wearing out, consumption or other loss of a value of a depreciable asset, or in the value we can write of a depreciable asset arising from use, afflection of time or obsolescence through technology and market changes. So, this definition is quite scientific in this sense that what is depreciation? It is a measure of the wearing out. Wearing out means from the wear and tear we are losing some of the values, or there is a decrease in the value of a fixed asset due to wear and tear, wearing out. Then consumption, if we will consume day after day, year after year something out of a fixed asset, then the fixed assets value will go on decreasing. Or other loss. Other loss means suppose there is an accident or something like that, there will be a loss. Other loss of a value of a depreciable asset. Some assets are not depreciable. As I told you, land is not depreciable. So, there it will not be applicable. But suppose the building or the land, building or plant and machinery or furniture and fixtures or motor vehicles, these things definitely will be called as depreciable assets. So, from their book value it will be going on reducing. So, arising from use, that means when you use it naturally it will wear and tear will be there. Afflection of time, even if you do not use, due to the afflection of time, due to the elapse of time, that will also occur. Or obsolescence through technology. Obsolescence means outdated, it becomes outdated. Take the case of black and white TV. Who is using black and white TV now? The technology has advanced and everybody is having color TV and this LED TV, etc. So, black and white TV, due to the advancement of technology and sufficient decrease in the value of market also, that has been wiped out. This is called obsolescence. So, these are the reasons why this depreciation will occur and how the depreciation will occur. Once you get the depreciation, it is allocated so as to charge a fair proportion of the depreciable amount in each accounting period during the expected useful life of the asset. Analysis is required for this also. Depreciation is allocated so as to charge a fair proportion of the depreciable amount in each accounting period during the expected useful life of the asset. Depreciation is allocated. What is the meaning of allocation? When we do not know exact amount to be charged and on some suitable basis we are giving the amount or attributing the amount to a particular section or particular department, that is called allocation. So, here depreciation, the process of distribution of depreciation is called allocation. So, depreciation is allocated so as to charge a fair proportion of the depreciable amount. First, let us understand what is this depreciable amount. Depreciable amount means the total cost in order to acquire the asset, install the asset, bring the asset to our premises, incidental expenses, altogether is called the total amount or total cost. Total cost less residual value, if any. What is residual value? Residual value means the value which it can fetch after the useful life of the asset. Suppose after 10 years, that is the expected life, we can sell it still as a scrap, say for 5,000 rupees. So, if it was 1 lakh rupees minus 5,000 rupees, then it will be 95,000 rupees, that will be called the depreciable amount. So, the entire depreciable amount is determined by deducting the residual value from the total cost. Then this depreciable amount will be apportioned or allocated, will be divided into the expected useful life. It will be divided by the expected useful life, because nobody knows exactly what will be the value of, I mean what will be the life of the asset. So, the expected life, expected useful, that means not that we will keep it simply and it will not work, it is of no use. So, only useful life, that to expected useful life. Suppose expected useful life is 19 years and the depreciable amount is 95,000, that is 1 lakh minus 5,000, 95,000 rupees will be divided by 19. So, 5,000 rupees will be called the charge a fair proportion. This fair proportion is 5,000. So, that 5,000 rupees or the fair proportion of the depreciable amount will be charged from time to time from the profit and loss account every year. So, that is the implication of this sentence. Then we will come to the third definition, which is given by International Accounting Standard Committee. So, it is the largest body, that is International Accounting Standard Committee. They form the international accounting standards, and according to them, depreciation is the allocation of the depreciable amount of an asset over its estimated useful life. So, this is the definition given by International Accounting Standard Committee. Depreciation is the allocation again of the depreciable amount, we have already understood, of an asset over its estimated useful life. So, if the estimated useful life is 19 years, the depreciable amount is 95,000, 95,000 divided by 19 is equal to 5,000, that will be allocated to every year's profit and loss account. So, this is the definition given by International Accounting Standard Committee. One more useful definition we will discuss and conclude the definition of depreciation. Depreciation is the process of allocating the cost of a fixed asset less any residual value over its essential useful life in a rational and systematic manner. So, this is the last definition which we are telling that it is the most precise definition in this sense. Depreciation is the process of allocating, that we have already understood, the cost of a fixed asset less any residual value. That means it is making it very clear what is the depreciable amount. Without writing the term depreciable amount, it is writing the cost of the fixed asset less any residual value. If there is a residual value, that residual value will be deducted, like 1 lakh minus 5,000, that 5,000 is the residual value. If there is no residual value, it will be 0. So, total 1 lakh rupees becomes the depreciable amount. Over its essential useful life, again expected life, in a rational and systematic manner. Rational and systematic manner is technical. Rational because it must be justified. How much? Suppose in the first year a car is being used, it does not have much of depreciation, but we are charging more depreciation because the cost is more, according to some methods like diminishing balance method, etc., that we will discuss in detail. So, it should be reasonable or rational and in a systematic manner. Everything in accounting is made in a systematic manner. So, here also the depreciation process should be, or depreciation amount should be calculated in a systematic manner. So, this is the definitions, or these are the definitions of depreciation. First term is depreciable asset. So, what is a depreciable asset? As I have already mentioned, suppose land is a fixed asset, only the fixed assets can be depreciable. Current assets are not depreciable, because current assets will be valued from time to time, but they are not depreciated. Then only the fixed assets, out of which some fixed assets, like I told you, land will not be depreciated. It is not a depreciable asset, it will be rather appreciated. The value of land becomes more and more, that is why it is not depreciable. So, we are talking about only those assets which are depreciable asset. So, depreciable assets are associated with limited life. That means, the characteristic features of depreciable asset is that it will be run only for a limited number of years, maybe 20 years, maybe 5 years, maybe 7 years, but limited. After that it cannot work, it cannot work for any times to come, for an eternal period. Limited life, then used during more than one accounting period. The use of this asset is for several periods, several accounting periods, more than 1 year. Then it is held for use in the production or supply of goods and services. This asset must be used in order to produce goods or services, or distribution of produced goods and services. So, these are the characteristics of depreciable asset. Now, coming to the useful life, second term is useful life. This term useful life refers to the life period, lifespan of that particular fixed asset in which effective use can be made, not that it will be just kept in the stores. It should give us some utility, it should help us in production. So, then only it will be useful. So, useful life, the characteristics may be like, it may be shorter than the physical life. The actual life may be more, but the useful life is less. Physical life means until and unless it is mixed with the soil, or it is evaporated, or it is destroyed, or it is spoiled completely. So, second one is predetermined. Sometimes, suppose take the case of a lease. Lease is taken for 10 years or 100 years, whatever it may be. After that it expires. That means you will not become the owner of that particular leased property. After the lease period is over, which is legal, then you will have to leave that. So, that is called predetermined period. Third one is directly governed by use or extraction. Suppose take the case of a mine. The more extractions we make, the more will be the amount of depreciation, and a day will come when there will be nothing left in that particular mine. Suppose take the case of a coal mine. If the total content of the coal mine is say 1 lakh tons, every year suppose 10 lakh tons we are extracting, in 10 years it will be 0. So, that will again give depreciation. So, that amount 10 lakh rupees, the cost of that 10 lakh rupees or the value we can say is the amount of depreciation. That is called a wasting asset. In case of wasting assets like mines, this will be the amount of depreciation. Then reduced by obsolescence. If there is any outdated work, that means if there is any obsolescence means it will be of no use after some years. Due to change in the style or fashion or technology, whatever it may be, it becomes obsolete. So, that is again your useful life will be determined by taking into consideration the obsolescence. Then matter of estimation. This useful life is not exact, that will be only estimated. If we estimate that it will run for 10 years, it may run for 12 years also, it may run for 8 years also, but the estimated life will be taken to be the useful life. You have to estimate beforehand. Then third point is depreciable amount. As I told you, the total cost minus residual value is equal to depreciable amount. Depreciable amount is equal to total cost, that is cost of acquisition, then installation expenses and incidental expenses, all taken together is called total cost, minus residual value, the scrap value at the end of the estimated life, how much it will fetch if it will be sold as scrap, that will be deducted and it will give us the depreciable amount. Then residual value, or it has come number 4. Residual value refers to the scrap value or the ultimate scrap value which the fixed asset is expected to fetch at the end of, at the expiry of the estimated period of life. If we are estimating, if we are expecting that a particular machinery worth rupees 1 lakh will be sold only for 5,000 rupees after 20 years or 19 years, then we can say that 5,000 is the residual value. Causes of depreciation. The first cause is physical deterioration. Physical deterioration refers to the decrease in physics of the asset. Suppose take the case of the life of a tire used in cars. There is an estimated life, say 4 years or 5 years, but if you have got a car and you are using it rarely, then it may go for 10 years because of the physical deterioration, because the physically it has not deteriorated. So, that is the first reason, due to the physical deterioration, how it will affect. The depreciation amount will go on increasing more and more if the deterioration is more physically. Number 2 is economic factors. Obsolescence, this is an economic factor. Economic factor in the sense, due to the advancement in technology, the goods which are used previously in the previous years may not be used now. I have given you the example of black and white TV, or for that matter suppose a radio set, now very rarely used. Due to the advancement in the technology, everybody is having the radio in its in their phone itself, in their mobile phone. You can see the you can listen to the radio centers. So, here similarly if you can have only one telephone of this size and listen, what is the use of keeping so big a radio? Similarly, the black and white TV and the LED TV now available. So, LED TV is very slick, very easy to replace, less costly in comparison to those days bigger ones, voluminous black and white and color TVs. So, due to change in the advancement in the technology, those things have become obsolete, and this is one of the economic factors why depreciation is taking place. Then the number 3, time factor. Suppose take the case of lease. A lease is taken for 15 years. So, after 15 years you are not the owner. So, whatever use you are making it in 15 years. So, whatever money you have given in order to acquire that lease, that will have to be distributed over 15 years and will be apportioned to various years within these 15 years. Because beyond that you do not have any legal right to continue as the owner of that particular lease, somebody else will take it away. Therefore, the time factor is again giving rise to depreciation. If it will be for all times to come it is with you, then the depreciation will be still less. Number 4 is depletion. Depletion refers to the reduction in the value of mines. It is one of the wasting assets. Mines are wasting assets. The more and more extraction you are making, the amount of depreciation will be also more. Because it is wasting asset, mines have got limited stocks of minerals. If you take it more and more, depreciation will be more and more. If you take gradually, slowly, less and less amount of mineral products you are extracting every year or year after year, then the amount of depreciation will be less, otherwise it will be more. So, this is applicable only to the mines. After depreciation, the last point is accident. This is one more reason which is not in the hands of human beings. Accident. Accident is always accident. So, whenever an accident takes place, your vehicle, its price decreases. the value decreases because something is broken, something is needing some repair, etc., all these things. So, this accident is another cause, rather a major cause of the depreciation. So, after these causes of depreciation, we will come to different types of depreciation or different terms used for depreciation on different types of assets. Here we will discuss about the differences between depreciation, depletion and amortization. Depreciation is used for all tangible fixed assets. Tangible fixed assets will include your building, plant and machinery, furniture and fixtures, motor vehicles, all these are tangible fixed assets. So, depreciation is the language used for mentioning the decrease in the value of these assets, that is called depreciation. Coming to depletion, it is meant for wasting assets. The decrease in the value of a mine is called depletion, not depreciation. So, wasting assets may be coal mines, stone quarries, oil reserves, petroleum wells, all these are called wasting assets. So, when we extract coal, that is the depletion. When you take away some stones from the stone quarries, that is depletion. Oil reserves are there, and if you take away some oil out of it, its value decreases, that is the depletion. So, all are referring to the depreciation, but the technical word used for this is called depletion. Now, coming to amortization, this is the depreciation on intangible assets. They are also fixed assets, but they are intangible. What are the examples? Goodwill, trademark, copyright, patents. Goodwill is the reputation of a firm. If you are making more profit than the other competitors engaged in the similar type of business, it is contributing to goodwill. That means you enjoy goodwill, otherwise you do not have goodwill. Goodwill is an intangible asset, we cannot touch it, we cannot feel it, but it gives us some utility. So far as it is giving us utility, it is helping us to acquire more profit, to earn more profit, then it is very much there. But once your profit is decreasing, then your goodwill is not there, but you are showing the goodwill at a particular figure in the asset side of the balance sheet. So, what you have to do? You have to reduce it, you have to write it off. So, that writing off is because the goodwill has been depreciated, goodwill has been reduced. So, that reduction in the fixed asset value is called depreciation, but here we will call it amortization. The word applicable for this is amortization, not depreciation. Similarly, that is in case of trademark, copyright and patents too. So, in all the cases, if it is useless because these are intangible assets, we have to try to write them off, but it cannot be written off in 1 year because there will be heavy loss. Therefore, over the years, once you have felt that it is not having any value, they becomes useless. So, you have to write them off in various years. So, in various years, whatever amount you are going to deduct from their amount, their book values, that is called the depreciation, but technically it will be called amortization. Amortization word is applicable for depreciation on intangible assets like goodwill, trademark, copyright and patents. Now, what are the factors in measurement of depreciation? So, what are the factors which are responsible or which will be helpful in calculating the amount of depreciation? The first is cost of the asset. Suppose take the case of two cars. One is an Audi car. Its price is near about 50 to 60 lakhs, suppose 50 lakhs. And you have got one Maruti Alto. Its cost is suppose 5 lakhs. If the estimated life of the asset in both the cases are 10 years, the annual depreciation in this case, if there is no residual value of course, will be 50,000, but here it will be 5 lakhs. The amount of depreciation is more in case of Audi cars in comparison to Alto cars, which is only 50,000. This is 5 lakhs, 10 times, because the cost is 10 times also. So, it is the cost of the asset which is directly proportional to the amount of depreciation. So, while calculating depreciation, we have to take into consideration the cost of the asset. The more the cost, the more amount will be the depreciation. Number 2 is the residual value. Suppose the resale value after the estimated or expected years of 10 years of life, suppose it can be sold for say 5 lakhs, and this Alto car suppose can be sold for 1 lakh. Then the total depreciable amount will be 45 lakhs. And here it will be 4 lakhs. Then divided by 10, it gives you 4.5 lakhs annual depreciation. Divided by 10, it gives you excuse me 40,000. In my first example, so far the cost of the asset was concerned, I have taken two cars. One car is 50 lakh, another car was 5 lakh. So, the amount of depreciation taking 10 years of estimated life in both the cases was 5 lakh in this case and it was 50,000. Again, the ratio between the depreciation of both the cars is 1:10. But here, because other things remaining same, estimated life remaining the same of the two cars respectively, and also the cost remaining the same, only because there is a change in the residual value. Here it is 5 lakh, here it is 1 lakh. So, it is coming to total 45 lakhs divided by 10, 4.5 lakhs, and it is coming to 40,000. And 40,000 multiplied by 10, if it were 10:1 ratio, is 4 lakh, but the annual depreciation is much more in case of OD, and even it is the ratio between the depreciation of both the cars is more than 10, or you can say approximately 11:1. So, residual value will also play a part in the computation of depreciation. And the third one is expected life. expected useful life, in both the cases we have taken 10. But if expected life will be 10 in case of Audi cars and 5 in case of suppose Alto cars. So, here we can take it 45 lakh divided by 10, 4.5 lakhs annually, and this will be 4 lakh divided by 5, that is 80,000 annually. So, it is again changed, the ratio is again changed because the expected useful life is differing. If the expected useful life will be taken into consideration, naturally the depreciation amount will be determined by taking into consideration all the three things, including the expected useful life. Then we will come to the methods of computing depreciation. Actually, there are 10 methods of providing depreciation. Number 1, straight line method. Or it is also called fixed percentage on original cost method. Number 2, diminishing balance method or this is also called fixed percentage on written down value method. Number 3 is sum of the digits method. I will just briefly discuss about all the methods. Number 4, annuity method. Number 5, sinking fund method. Or depreciation fund method. Then number 6, you have got revaluation method. Number 7, depletion method. Number 8, machine hour rate method. Then number 9, insurance policy method. And lastly, replacement method or replacement cost method. Straight line method or fixed percentage on original cost method. Suppose the original cost of the machinery is 1 lakh, the total cost, including your installation and incidental expenses, and if the estimated life is 10 years, it is coming to 10,000. So, 10,000 is just the 10% of 1 lakh. Every year on the original cost of 1 lakh, we will calculate 10% and your annual depreciation will be 10,000. The characteristic of this method is that the amount of depreciation year after year will remain the same. Second one is diminishing balance method or fixed percentage on written down value method. So, diminishing balance or written down value refers to the book value. That means total cost minus depreciation in the first year becomes the diminished balance as in the beginning of the second year. And if we provide the same percentage of 10, that is 10%, in the first year it will be 10,000, but out of 1 lakh you have to deduct 10,000 in the first year, so that in the beginning of the second year it is 90,000. Although the first year depreciation will be same as per the straight line method in case of diminishing balance method, the second year depreciation will differ. How? Into 10% is equal to 9,000. In this way, in the beginning of the third year it will be 81,000, and again 10% in the third year it will be 8,100. So, 9,000, 8,100, 10,000, like this. It is going on declining, it is going on decreasing. The amount of depreciation is going on diminishing year after year gradually. Similarly, sum of the digits method is another method where the same way the amount of depreciation will go on decreasing year after year. Coming to annuity method, the interest on the investment of the asset which is not taken into consideration in other methods is taken into account in the annuity method. Not only the depreciation will cover the cost, but also the interest, the notional interest which otherwise it would have gained or earned, that will be taken into consideration. In the sinking fund method, the amount of depreciation every year will have to be determined by referring to one sinking fund table. A fund will be created, that is depreciation fund, and this amount every year will be the same, and it will be invested in some profitable channel, and that investment will be sold just before the expiry of the life of the asset, and that will provide sufficient funds. Cash will be provided by that, and there will be no hardship in replacing the asset. So, that is in case of sinking fund method. The next method should be insurance policy method. Insurance policy method is equal to this method, excepting one fact, that you need not prepare any fund or something like that. You need not invest. Simply talk to one insurance company and tell them this is the cost. After 10 years this will be the cost. How I will be getting back 10 lakh rupees or that amount which is required to replace the asset. They will be giving you a certain amount as premium. So, that premium you have to give, and that is the amount of depreciation. So, the uncertainty in case of sinking fund method for selling the fixed asset or the investment is not coming in case of insurance policy method. Then coming to revaluation method, it is applicable to the loose tools. Every year at the beginning and at the end it will be revalued. Suppose the amount of, it is applicable to loose tools. Suppose the total loose tools were in the beginning it was 10,000, you have purchased 5,000 during the year, so it should be 15,000. When you revalue it at the end of the period, end of the year, suppose it is coming to 7,000. So, 15,000 minus 7,000, 8,000 will be the depreciation of that year. Like this it will go on. Then coming to depletion method, it depends on the, or it is applicable only to the mines. So, the more mineral products you extract, the more will be the amount of depreciation, that is applicable here. Then machine hour rate method is nothing but a derivation of this diminishing balance method or straight line method. So, in machine hour rate method it will be calculated, the total amount of depreciation will be calculated not per annum, but per hour. If a machine runs for 1 hour, that is 1 machine hour. Per 1 machine hour, suppose it is 3 rupees. If in a particular year it will be running 3,000 hours, 3,000 into 3, that is 9,000 rupees will be the amount of depreciation. That is in case of machine hour rate method. Then coming to the replacement cost method, which is rather a new method. So, in this method what happens? The amount of depreciation will depend on the replacement cost of that machinery, not the original cost, but the replacement. Suppose we have purchased it for 1 lakh rupees, but after 10 years of estimated life it will be replaced by another machinery which will be requiring 2 lakh rupees. So, on 2 lakh rupees rather we will have to calculate the depreciations, so that at the time of replacement we have got 2 lakh rupees in hand. So, anyway, the most important point is we have got only 2 methods in our courses of studies. So, we will read in detail the operation of the straight line method and diminishing balance method in the next class. Thank you.